Welcome to the CFA Society India podcast, where society members engage in conversations with industry experts to bring you unique insights. This podcast represents the views and opinions of the originally featured speaker and is posted with their express consent. The podcast is meant for educational purposes only. It should not be construed as research, recommendation, solicitation, or investment advice by CFA Society India. Now, let's dive into today's episode.
Hello everyone, welcome to the CFA Society podcast. My name is Labanya Prakash Jena. I am host of this podcast. As we know that the global economy, including India, is going through a green economic transition due to climate change, and this transition is creating both opportunities and challenges for investors. However, in this case, when we're talking about transition, the role of government, international institutions, and international cooperation is becoming very critical to mobilize the capital required for this green transition. Today with us, Dr. Mukund Rajan. He is the chairperson of Ecube Investment Advisors, a first of its kind platform created in 2019 to catalyze ESG changes in corporate India. Prior to this, he held a number of senior executive positions throughout his 23 years career with the Tata Group, where he served as the brand custodian of the Tata Group. Dr. Rajan serves as a mentor of the Environment and Climate Change Committee, FICCI, and is also a member of the ESG Advisory Committee constituted by SEBI. Dr. Rajan, welcome to the CFA Society. Thank you very much for agreeing to join the podcast. To start with, could you briefly say about what are the issues related to climate change, why investors and financiers should be concerned about this? Over to you, Dr. Rajan.
Thank you. Thanks for having me on this program, Labanya. I guess climate change is the big issue that is now really upon us. We've seen some of the highest temperatures, not just in this country, but across the world over the past few years. And with each passing year, temperatures seem to be going ever higher. And that has enormous consequences for agriculture, for every part of the economy, for human productivity. And therefore, there is growing investor concern whether economies are actually able to deal with this challenge going forward. And they want to see how businesses are responding, both in terms of mitigating their own impact on the environment, so controlling their carbon emissions. And also, increasingly, they're looking out to see whether businesses are able to adapt to the implicit changes that are already upon us. We know that there is a certain amount of global warming that is already embedded because of the actions that have taken place in the past. And therefore, there has to be a certain amount of adaptation that anyway takes place. So they're trying to see whether businesses are preparing themselves for this future. What investors don't want is to be backing businesses that are unprepared, certainly compared to their peer set. They don't want to be stuck with stranded assets where businesses have had to abandon investments that have already been made. So there is a great deal of concern in the investor community about how businesses are preparing themselves. And I think countries like India, which have very large coastlines, which have a large part of the population that is in the lower levels of the pyramid in terms of income, will be potentially more challenged because of the impacts of global warming compared to many other markets around the world. So there is concern that between actions of the government and responses of business, there is adequate preparedness to deal with the challenge of global warming. So really, investors are looking out to see that risks are being adequately managed. Equally, where opportunities present themselves in spaces like renewable energy, electric vehicles, energy efficiency, and so on, that businesses are also seizing these opportunities and trying to do better. So I think these are the kinds of issues that investors will be looking out for. All of this, of course, requires some level of investment, both in terms of financial capital, but also human capital and intelligent strategies. And therefore, on all of these dimensions, businesses are going to be tasked to really do better and to give a good account through disclosures of what they're actually doing.
Okay, I'll just go back to India also. I mean, as we know that India has declared at Paris Agreement to decarbonize its economy by 30 to 33% by 2030, but India had already achieved that. Now India has also declared to achieve net zero by 2070 or so. It means that India needs to transition its economy very, very quickly in the next couple of decades or so. So could you briefly provide an overview India's green economic transition plan, how it is going to play an important role in limiting global temperature?
So in many ways, you could argue that India is actually ground zero in the efforts to deal with global warming. We are the third largest producer of greenhouse gases in the world after China and the United States. So there is, therefore, significant interest in how India is dealing with this challenge. At COP26 in Glasgow, you mentioned one of the elements that was announced, the so-called Panchamrit, which the Indian government announced as its commitment to dealing with the problem of global warming. One was the point you made about achieving net zero by 2070. But there were also many more proximate targets. So the government actually enhanced its commitment on reducing emissions intensity of the economy to 45% over 2005 levels by 2030. It also declared that 50% of its electric power capacity would come from non-fossil fuel sources, essentially renewable energy. And earlier, the government had already announced a target of 500 gigawatts of non-fossil fuel energy capacity for the Indian economy by 2030. And big targets on afforestation and creating carbon sinks, 2.5 to 3 gigatons of carbon. So I think there are some very ambitious targets that the government had already announced at Glasgow. And the government has been, I think, quite forward-looking and visionary in sensing that there is also an opportunity for India to bypass, if you will, some of the old models of development which the West has experienced. In some ways, India as a country has seen the benefits of leapfrogging generations of technology in other sectors. So if you think about telecommunications, India leapfrogged the entire fixed line rollout and went directly to mobile technology, to the extent where today in India, you have a few tens of millions of fixed line connections, but you have close to 1 billion mobile connections. So something similar could potentially be achieved in the renewable energy space, avoiding some of the perils of going with fossil fuel-based thermal power generation, for instance. I think likewise, many other sectors of the economy are being prompted by a set of government rules and regulations to do better and to avoid environmentally destructive modes of growth. And we are seeing, therefore, the benefits of this in sectors like transportation with electric vehicles. We're seeing it in green construction, which is a very large space in India. The thought is that 70 to 80% of the buildings that India will need by 2050 are yet to be constructed, and therefore a significant focus on green construction becomes very important. And so in sector after sector, you're seeing that there is a willingness to now embrace some of this green agenda. Last year, when the government presented its budget, green growth was declared as one of the pillars for the Indian economy going forward. And therefore, there are a whole set of propositions from the government side on supporting, facilitating, nudging the private sector to move down this path. And equally, there are the beginnings of efforts by the regulators to try and test businesses and how well they're adapting to this new green agenda. So just to give you two cases in point, in the case of listed companies, the public markets regulator has put in place a mandate for the top 1,000 listed companies to produce what is called the Business Responsibility and Sustainability Report. And this report has core elements in it, which from next year will also require to be audited to standards of reasonable assurance, and therefore will give a very good account from businesses of how they're performing on a range of environmental parameters, including energy efficiency, water management, and so on. Likewise, the central bank, which oversees the banking system in India, is now increasingly tasking Indian banks and non-banks to look at the financed emissions and to put in place programs and strategies to ensure that there's adequate risk monitoring and management going forward. So I think all parts of the economy are slowly but surely being pulled into this very positive agenda around green growth in India.
You just said about investment opportunities available for investors. In the green transition pathway, but at the same time, we are also looking at the amount of capital required in the next couple of decades. For example, McKinsey is saying that we need $12 trillion. CEW, which is another agency, they are saying India needs $10 trillion to achieve net zero. Even government's own estimate, they suggest that we need around $350-400 billion just to meet a 500 gigawatt capacity of renewable energy. At the same time, if we see that the amount of capital mobilization, it could be in the range of $50-60 billion per year. So it means that there are challenges to attract capital. So could you throw some light? What are the challenges? How the challenges can be addressed for investors?
Yeah. So if you look at the way many of these programs are getting financed, let's start with debt and equity and look at the large businesses and the big projects. I think for the most part, large corporates, large enterprises tend to get the financing they need, be it in the form of debt or equity. Typically from the banking system, but also from some of the large international private equity funds, for instance. So think about utility scale renewable energy, for instance, the 500 megawatt, 1 gigawatt kind of solar and wind power projects. 15 years back, these are very difficult to finance. At that time, tariffs were quite high. Costs for installation of these projects were also quite high. But what we've seen over the last 15 years is a dramatic decline in costs and a commensurate decline in tariffs that now makes renewable power quite competitive compared with thermal power in India. And therefore, achieving financing for many of these projects is no longer a challenge. So the large enterprises, I think, get the capital that they need from the domestic market and to some extent from the international market without much difficulty. But as you go down the pyramid and you start looking at the micro, small, medium enterprise, you look at new ventures, you look at the startup community, financing becomes a very big challenge. It's also, by the way, an opportunity, therefore, for investors who are looking at the complete spectrum. What we've seen on the venture side, for instance, as a case in point, over the last decade and a half, there has been less than $3 billion that has been deployed in startups, in a whole range of climate-related sectors. Compare this with well over $200 to $300 billion that has been deployed in utility-scale renewables alone. So the 3 billion is a tiny piece of that. But what's perhaps even more concerning is 8 out of 9 ventures that were able to receive some part of that 3 billion never went beyond one stage of financing. So they never went to another round of financing. And that's not because they didn't need the capital. It's because the capital is not made available. And some of those businesses obviously have gone bust subsequently because they haven't been able to raise the financing. In the middle, you have the mid-market, and you have a few private equity growth funds that address that. But typically, if these companies need capital, they go to the debt markets, where they rely on the conventional banking system for the most part for their funding needs. They're required to pledge collateral, which oftentimes for promoters becomes things like their houses, hard-earned wealth that they're forced to pledge, whatever assets they may have to raise financing. So it is a tough situation for smaller companies for the most part. Therefore, I think there is going to be a significant need for a new set of investors to come in and address both the need that exists and also the opportunity, quite honestly, to provide risk capital to many of these smaller companies, smaller entities in India. Now let's talk about the banks, the conventional banking system. Why is it that they don't do enough for the smaller companies? And I think a big part of the reason is just the historical context. The banks in India have emerged somewhere towards the second half of the last decade from a pretty rough period where they had run up huge non-performing assets. They had weak balance sheets. Many of them were inadequately capitalized. They've made substantial improvement over the last decade or so from that situation. They are therefore quite risk averse now in terms of getting into sectors that they may not understand fully, looking at new technologies, which is often the case with climate mitigation technologies that they don't understand. For instance, what is the residual value of a new electric vehicle or a new battery? So how do you deal with these kinds of risks? And so the banks have tended to stay clear and just rely on the conventional banking relationship, corporate banking relationship with many of these businesses to offer any support. But that's not particularly helpful. So I think that is where there is an opportunity for newer entities to come in, for some of the non-bank finance companies, the NBFCs, to play a more important role, and certainly for venture funds and growth capital focused private equity funds to come in. A lot of this will require capital from overseas. So foreign capital, I think, has a big role to play in supporting the continued evolution of many of these smaller businesses in India. And I think the government understands that. And there are, I think, ways in which now efforts are being made to attract more capital to come into the country and support some of these requirements.
Thanks, Dr. Rajan. I mean, you just briefly highlighted the challenges and issues in getting capital from mainstream financiers, even for small companies, as well as the technology, low carbon technologies, which are not commercially viable now. It will take maybe a decade or 2 decades to be commercially viable. So what are the financial mechanism or financial policies currently the government of India is taking so that capital can flow to low carbon technologies based on the riskiness? Because if the project is risky, like we said, financiers will definitely not come in. And on the other side, we can see that government, particularly both in Europe and United States, they are heavily investing in low carbon technologies as well. So if you can give us a broad overview, what are the steps government is taking? What are the steps they are likely to take in the future that will help the investor understand the policy landscape on low carbon technologies?
Yeah. So again, I think one can look at larger projects and one can look at the needs of the smaller enterprises as two perhaps different categories of investment requirement, which the government is addressing. And the larger projects, there are big scale interventions that the government has sought to support. For instance, we have a scheme in India called production-linked incentives that are given to support manufacturing in some of these spaces that require support. So think about solar power, production of solar modules, panels in this country. Think about electric vehicles, the FAME scheme, the faster adoption and manufacturing of hybrid electric vehicles. These are all schemes that the government has floated to offer large concessions and subsidies to big projects to make in India, to produce some of these very important requirements in India using new technologies. Likewise, the government has announced a national green hydrogen mission with an investment in the first year itself of close to $2 billion, which will again support the production of electrolyzers in this country and incentivize that in the private sector. So there are these large projects which the government is offering significant concessions, subsidies. Even foreign investors can come into India and avail of some of these concessions in order to produce in this country. And providing they meet certain targets in production, they get fairly handsome support from the government. Then if you look at the smaller enterprises, there are organizations such as SIDBI, the Small Industries Development Bank of India, which are trying to promote various forms of what you might call blended finance, offering some combination of guarantees, risk-sharing mechanisms to really support many of these smaller enterprises in achieving their required outcomes. So trying to facilitate funding from the private sector with some backstop, some counter guarantee, some risk sharing that SIDBI can put in place. The other interesting thing that SIDBI is doing is to try and give smaller enterprises the power of scale. How do you do this? By getting them to aggregate volumes. So they've looked at a few clusters of small and medium enterprises. If you can get small entities that on their own might not be able to write a large enough check to interest a provider of a service or a large vendor, maybe the trick is to get a number of these companies to get together, and then you get economies of scale. And through that, you can create shared infrastructure, such as common effluent treatment plants, significantly large solar power deployments, for instance, in a solar park. And that's something that SIDBI has been trying to promote, and again, offering guarantees and some concessional financing for those kinds of projects. So I think the government is cognizant of the challenges that exist. It's doing its bit to try and support some of these initiatives. But having said that, government will also be challenged, right? There are limits to how much of finance can be provided by the government. It has a very large fiscal deficit that it has to worry about. It's a shade under 6% of GDP at the moment. And that's something the government is committed to bringing down. So there will therefore be a need for private finance to step in. The other area that government is looking to is the role that the multilateral development banks could play, because they could certainly step in and offer some of the support that normally would be expected from government in some of these blended finance solutions. So can institutions like the World Bank, the Asian Development Bank play a role as well? Can some of the other large international financiers, the development financial institutions, the sovereign wealth funds, can they step in and provide some support? Also, it's quite interesting that at Dubai at COP28, the most recent conference of parties on climate change, there was a deliberation between the large sovereign wealth funds. And there seem to be certain initiatives now emerging with them focusing on a few breakthrough technology interventions in spaces like green hydrogen, for instance, which could also bring something quite meaningful to the whole deliberation. So if a technology and certain standards could be defined and a breakthrough achieved, and that could then be made available at a low cost or just at cost indeed to all the developing countries, including India, then it saves some of the financing that you would need for those large projects. So I think there are some fine minds that are trying to come together and figure out how the efforts that governments like the Indian government are making can be further supported. The last thing, of course, is the government is looking at some innovation in financing. It announced sovereign green bonds in the last budget, so over $2 billion worth of sovereign green bonds, and now that number is being topped up, which will go towards funding some of the government's public sector enterprise requirements for green investments. So I think an effort is being made on all fronts to try and harness the power of capital, to bring public-private partnerships to the fore, and to think of innovative ways in which some of the smaller enterprises can also receive support. So a lot that's going on in India, but it's never going to be enough given the scale of requirement that we have, the numbers that you talked about, several $100 billion a year for the rest of this decade and going forward, that simply cannot be achieved without a huge dollop of foreign capital coming in.
Thanks, Dr. Rajan. So I have last question regarding, you spoke about, you have written in your book on how ESG can benefit businesses. But on the other side, investors are really struggling to differentiate between good ESG companies and bad ESG companies. There are issues around ESG funds also launched by several funds here in India as well. And there are also question mark on the ESG rating provided by rating agencies as well. So as investors, what are the things they should know, how they can differentiate between a bad ESG company and good ESG companies. So if you can throw some light, it is really helpful to our audience.
Sure. So let's look at a couple of the contentious issues and my own perspective on those, and then I'll sort of give you a sense on how you sort of differentiate between good ESG and bad ESG. So there is a view that companies that are on the path of improving ESG performance don't necessarily deliver better returns. And an example was provided, for instance, last year, soon after the Russia-Ukraine war broke out. The fact that many of the best performing stocks in the world were oil companies, fossil fuel producing companies that were clearly poor on ESG, certainly in terms of climate impact, but were delivering extraordinarily good returns. So that is one illustration of, ESG doesn't seem to work in terms of returns. But I think that is very myopic and short-sighted, because ESG is never meant to deliver a quarter-on-quarter kind of benefit. I think the value of an ESG rating or a ESG metric that gets monitored is really around what it tells you about risk and opportunity, and that too in the medium to long term. In the short term, anything can happen, but it's the medium to long term, and it's the risk return equation that you're looking for, which ESG helps to inform better. So that's the first point. The second point is ESG can mean many different things to different people. There are ESG rating agencies that track over 1,000 ESG parameters. Now, clearly, no sane individual is going to be able to make sense of over 1,000 parameters simultaneously. You need a supercomputer to do that for you all the time. Therefore, you have this concept of materiality. That is the key metrics that really make a difference in the performance of a company or a business. And it's the material ESG metrics that you need to focus on. And sometimes you're quite adequately informed to be able to take a strategic decision with information on just a handful of material ESG metrics, even 4 or 5. So you don't have to churn the ocean to figure out what's happening on 1,000 different parameters. It's good enough to have information on a select few to be able to make an informed choice. So all that said, the next question is, why is it that one ESG rating provider has one kind of score and another ESG rating provider has a very different score? Well, it's a lot to do with the algorithms and the models that they use and what they're measuring at a point of time. So it's just like the stock market. There are a set of brokers who will have a buy on a stock, and there are equally a large number of brokers who may have a sell on a stock. And they're all using supposedly the same public information that's available. None of them has insider information. And yet they have exactly contradictory propositions on the same stock. And I think that can happen, therefore, with the ESG ratings. Ultimately, I think what investors need to do is find a rating model that they are comfortable with, or indeed create one for themselves, based perhaps on just a few material ESG parameters. You can do that working with expert agencies, and there are many of those now in the market. What you do need is authentic data to be able to populate those models. And I think in India in the past, we've actually lacked a lot of the data. But now, thanks to the public markets regulator and the BRSR proposition, the Business Responsibility and Sustainability Reporting Mandate, you will have data, and from next year it will be audited, and therefore fairly authentic data that's available that can be used to populate these models. So my advice would be, figure out what works best for you, and then stay consistent with that, because what you want to see over time with companies is, are they improving and delivering better and better on the same ESG metrics? And therefore, you will need to build a time series of data points on the performance of companies on those ESG metrics. And that's really where the strength of ESG as a framework becomes evident. If you can see which are the companies that are improving on a consistent basis, those are the ones I would describe as good ESG companies. And the ones that are clearly not going anywhere or treading water and really staying in the same place or indeed declining are the ones I would describe as bad ESG companies. But the important thing is to use that framework to get a better sense of which businesses are really addressing potential risk in the future and also accessing opportunities that are being thrown up because of the entire landscape around ESG. And then back the ones that you think are doing a better job and track the performance over time using the ESG rating that you're comfortable with. And don't expect the ratings ever to be identical. It's not like the debt markets where typically on bond issues, most rating agencies will converge on the same rating. In ESG, simply because it's such a diverse and disparate space, you can end up having very different conclusions on risk and opportunity for the future.
Thanks, Dr. Rajan. That was my last question. If you have any passing memory mark, we'll be happy to have that.
I was just thinking about our chat on the role of government in financing, but maybe I should just spend 2 minutes on describing many other actions that government takes in India to really promote the green agenda. And I think some of those are worth noting. We talked about big scale projects, things like green hydrogen. We talked about industrial policies, things like the production-linked incentives. But equally, the range of interventions around influencing consumer behavior. One of these is product labeling. For instance, today, if you go into the market to buy an air conditioner, you will have a rating system of 5-star, 4-star, 3-star, based on the energy efficiency of the air conditioner, which seeks to educate and inform the customer to make a better choice. And hopefully, more customers look out for 5-star air conditioners that are more efficient in their output. Similarly, the government has announced this whole program around what they call Mission Life or Lifestyle for Environment, which is really targeted at guiding consumer behavior and the behavior of individual citizens. The hope is that by 2028, 80% of India's villages and urban local bodies would have subscribed to many of the core principles of Mission Life. And that includes things like conservation of nature, adequate water management, things that are impacting your daily life and quality of life. And I think that's very significant because we are seeing that many of the problems, including climate change, are really of human origin. They are created by the materialism in society, by the demand for more products and services, sometimes much more than you actually require. So I think trying to address consumer behavior and the behavior of citizens is very important. Government is making efforts in that direction as well. And the range of other initiatives, but let me stop with that. I think, therefore, in countries like India, it's very important that all segments of society come together to find answers to many of these very complex challenges.
Thanks, Dr. Rajan. It was a pleasure to talk to you on the behalf of CFA Society India. We sincerely appreciate your willingness to carve out time from your busy schedule to join us for our podcast. Thank you very much.
Thank you. Thank you so much, Labanya.
Thank you for listening in to today's podcast. Before you go, please subscribe to stay updated on your favorite podcast app.